Hey, this is Wesley Wyrick with the Wyrick Mortgage Group, and thank you for joining in to Mortgage University. This next subject we're going to cover is credit and understanding how it works. Keep watching. So what is credit and how does it work? The credit score is basically a score, a grade on how well you do on paying back your debt. And it's a grade that can range anywhere from a 350 to an 850. 350 being the lowest and 850 score being the highest. So one thing is your credit score is one of the biggest drivers of your approval process for your home loan. One of the biggest, if not the biggest driver of the approval process of your home loan. Now we do have programs that start in the high 500s, but the higher that credit score you can get it, the better it is going to be for your approval situation. Whether you actually get approved or not, or even your interest rate, repayment, all that, cost, all that is going to be determined based off of that credit score. So ways to improve your credit. One, obviously, no late payments. Late payments report on your credit if they go beyond 30 days late. So if you're a few days late on making your credit card payment or something like that, that's obviously not a good thing, but it's not a detrimental thing for your credit because it's not going to hit your credit report until you are actually 30 days late. The late payments that you'll commonly see is a 30, 60, 90 day late, sometimes even 120 day late. If you're at that point, unfortunately, you're probably really low on your credit score where it's going to take a little while to bounce back from that. But hard times do happen to good people, and there's actually programs out there to help folks get their credit score where it needs to be for the home financing process. But just to circle back around, we do have programs that start in the high 500s. So if you think that you're marginable, take a second to reach out to us because we can help you make that decision on whether you're ready to move forward now or we can transition you over to some friends that we know that can help you with your credit score and getting it back on track. Another thing to share with you on the credit score is your credit utilization. One of the biggest things that helps drive your credit score is your credit debt utilization. So like your how much you use compared to how much your total limit is on the actual card, the credit card itself. For example, the highest credit utilization on a credit card is if you operate under 30% of your available credit balance. If your credit balance is $1,000, your available credit balance is $1,000, you want to operate within that first $300 to get the highest credit utilization. Typically that reports just once a month. So sometimes you can time it properly, sometimes you can't, but it's kind of hard to gauge. But if you operate within that first 30%, you're usually getting your highest credit utilization. And usually when we're working with credit scores and looking at credit scores with folks, and we're looking for some low-hanging fruit on how you can jump your score up pretty quick without having to go through the whole organic process of your score growing. Usually that's our low-hanging fruit. If we see a credit card balance, we say, hey, pay this down below this amount, and you'll see a spike in your credit. So another thing when it comes to the home loan process, when you are using sources like Credit Karma or Credit Sesame or Privacy Guard, those places to kind of gauge what your credit score is at, they're not 100% accurate, and they are not going off of FICO scores. So it's a good idea to watch that, to kind of keep your finger on the pulse to see where your score is at. But just know that that's not going to be the same score that we actually pull when we do your credit pull for your mortgage, because they aren't actually directly getting their information from the credit bureaus. When we pull in the credit report, we actually do a tri-merge report. So basically all three credit bureaus, Experian, Equifax, and TransUnion, pulled together on one report. And in the mortgage industry, we're required to go off of the lowest middle score for the applicants. So you have your middle score, your spouse will have their middle score, so the lowest middle score of the two is the one that we have to use for the approval process. What is the middle score? You take the highest score, the lowest score, and throw it out, and that's what we go by as the score in between, the middle score. So you do have three scores coming back from those credit bureaus still, even with the tri-merge report, but we have to do the appraisal off of the lowest middle score. So that, in a nutshell, is credit. If you have any additional questions than that, feel free to reach out to us or any of your mortgage experts that you know that can help you understand a little further if you have any more detailed questions. So with that, we hope you're having a great day. Stay tuned for more topics covered here on Mortgage University, and we'll see you on the next video. Thanks.